Welcome to the Real Estate Wealth Podcast, where we explore real estate as the most proven way to financial freedom. Join us for insights with leading experts and discover how vibrant health and an abundance mindset are the keys to true wealth. Welcome to the Real Estate Wealth Podcast. Today, we're diving deep into the current state of multifamily financing with trusted expert Luke Donahue. Luke is the Senior Vice President at Colliers, with over $2 billion in funded transactions throughout his career. His expertise spans the entire capital stack, from first mortgage debt placements to complex structured finance transactions. We've worked closely with Luke on several deals over the years, including currently working on a 140-unit property that we're looking to refinance. Luke is intimately familiar with the challenges and opportunities in today's market, and so I want to welcome him to the show. Luke, anything you want to add to that?
No, glad to be here.
Sure.
Always a pleasure to speak with you, and look forward to having a productive conversation.
Yeah, thank you. Yeah, these are interesting times, so I think it'll be enlightening for our audience to kind of get your perspective on what you're seeing at your level and kind of your feeling for the market today and where you think we're headed. So you and I met, Luke, back in 2013. You helped us refinance a little building in Tucson, and now currently working on another deal, coincidentally, in Tucson, which is kind of interesting. The only two buildings we've owned in Tucson, actually. But we've worked on a few deals together over the years. Financing over that 10-year period has changed tremendously, right? Things have evolved, especially in light of, what's happened with rates going up over the last couple of years, massively in really a relatively short period of time. Can you kind of just give our listeners an update of how the markets have evolved over the last decade and really over the last couple of years and what you're seeing today?
Yeah, certainly. Glad to jump into it. And it's amazing to look back and think that we started working together over a decade ago. And,
I know.
2013, when we first started working together, it was a completely different market environment. We were coming out of the GFC, which was 2007 to 2008, and 2009 to 10 was really a zero liquidity environment, and certainly impacted what was available from a financing standpoint when CalCap started to penetrate the Phoenix market and taking advantage of some really compelling price points, which were reflective of what happened during the GFC. So back when we first started, the capital markets were just really starting to ramp up, and you guys were actively closing with private capital money. A lot of investors were doing all cash deals, again, because it was really a zero liquidity environment coming out of that cycle. In 2011, 2014, Freddie Mac was really one of the first agencies to break back into the market, started providing some liquidity, and other lenders followed suit. Fannie was a little more cautious, dipping their toes back into the market, particularly in Arizona, due to some losses that they had coming out of that GFC environment. But slowly, banks and the CMBS market began to open back up, and we really had a pretty amazing run from 2014, really all the way through 2022. The current cycle that we're in. Really, if you just look back a few years, it's pretty amazing looking back at what's transpired. From a very healthy, functioning capital market environment, and then we had a global pandemic that came in and just changed the world and had a heavy influence on monetary policy. As you know, the government got very aggressive reacting to the pandemic, and interest rates really plummeted on the back half of 2020 after the pandemic started, and really began to fuel a very aggressive inflationary environment that pushed values up, pushed rents up, really aggressively moved the market forward. Pre-pandemic, it was a relatively normalized capital market environment, healthy, functioning Agencies were in the market. Bridge debt was in the market, but not nearly as active and aggressive as they were coming out of the pandemic. The CMBS market was there as a backstop for borrowers that needed them, and the insurance companies have been really steady Eddie up until that point. But with the inflationary environment that followed, and the rent growth and the valuation, the cap rate compression that was fueled by low interest rates, borrowers got very aggressive on transactions to take advantage of value creation that was occurring, and bridge debt became very much in vogue. And I would say 9 out of the 10 deals that we were working on from the second half of 2020 through early part of 2022 were all with high leverage, floating rate, short duration bridge debt. 75% plus loan to cost, floating over SOFR with spreads of, call it 300 to 400. It was a very aggressive market, a tremendous amount of liquidity in the market. The agencies were still there, struggling to compete with these aggressive bridge lenders. Insurance companies were still in the market looking for their share. And so there was really just a flood of liquidity, and money was tremendously cheap. Long-term fixed rates were in the low threes. SOFR was basically 8 basis points, so essentially zero. And so investors were taking advantage of the excess liquidity in the market, and we saw a tremendous amount of deal volume, and we were setting record numbers in terms of debt transactions and sales nationally. And then the Fed was late to react to the policies that they had put in place to react to the pandemic, and the Fed started raising rates, call it early 2022. And really has been unprecedented. I mean, if you look back during my career, rates from really the start of it, and I started in the business in 2001, they really had declined from 2001 all the way through early 2022. And so it really aided investment and assisted investors in realizing equity growth and assisting on business plans that maybe would be more challenged in a different capital market environment. And so from early 2022 to where we are today, we've seen multiple rate increases. And today SOFR, which 24 months ago, maybe more like 28 months ago, which was 8 basis points 28 months ago, is now 5.4%. And so, there's a tremendous increase in that index. Again, most of those bridge loans were priced at a spread over SOFR. So what might have looked like a low 3% interest rate at acquisition with a 300 spread is now 8.5%. And that's on the low end. So obviously there's some major movements for borrowers that have exposure to high leverage floating rate debt just due to the increases in the dominant index. Prime is also up, another dominant index that a lot of banks use, and treasuries had climbed through this interest rate adjustment period as well. And so here we are, July 2024, and we're in a starkly different interest rate environment than we were, again, plus or minus 30 months ago. And
yes, I think that's an excellent synopsis, Luke, of what's happened. And yeah, when you bring up when we started the company in 2008, the first deal we did in Phoenix was 2010, and even at that point, there was literally no financing available. So I don't know if you know, but the first 4 deals we bought in Phoenix, we had to buy all cash because I'd gone to banks, traditional capital markets guys. No one was lending. And even the hard money guys were lending, but they weren't lending in Phoenix. So we literally went 100% equity on the first 4 deals. And I remember someone telling me back then, they're like, take advantage now if you can, because once capital becomes readily available, these prices are going to shoot up, right? So the relationship between the availability of capital and price is a real one. And that's exactly what we saw, for the corresponding next 16 years as more and more capital came in the markets, rates compressed further, more activity happened until we saw the peak bubble of now looking back, I guess was late 21, early 22 maybe, where values peaked out, volumes peaked out, and the market just got very frothy. And to your point, so many aggressive bridge lenders came in and were just underwriting deals, on future rent growth that, may or may not have transpired. But those borrowers are at a point now where those short-term bridge loans coming due, and lo and behold, the property is worth less in a lot of cases than even the loan amount. And so, they're unable to refinance those properties. But one thing we're seeing, Luke, which we didn't see in 2008 when we were buying, through that cycle all the way through 2015, really, lenders back then were willing to foreclose and take properties back. And, what we're seeing, at least thus far in this cycle, is lenders are kicking that can down the road and doing workouts and modifications more than I've ever seen. So I wanted you to kind of touch on that a little bit. I mean, is the thinking that rates popped up so quickly that everyone's sort of betting that they're going to come down and it's going to save some of these loans, some of these borrowers, some of these deals? Or what do you think the thinking is on the reluctance to foreclose and what we're seeing? Because we've all been talking about, distress is going to happen. Everyone that bought during that peak period in 21, 22, they're in trouble, yet it has not transpired.
Yeah, that's a really great question. But I think it's very difficult to draw straight parallels from the way lenders behaved coming out of the GFC versus the way lenders are behaving coming out of this very low interest rate environment and now the high interest rate environment that we're currently sitting in. During the GFC, it was a zero liquidity environment, as you mentioned, and that was systemic, and it impacted not just owners of real estate. It also had a tremendous impact on various financing sources, and it created additional pressures and forces that caused lenders and banks to take action. Coming out of the GFC, I think the lenders that weathered the storm the best were the ones that did adapt this pretend and extend strategy, which was a common term for several lenders, where they would mothball deals and just operate them and brought them to market several years post GFC. And so today, here we are. The stress in the market is really for deals that were purchased in 2020 or later. If you bought a deal in 2019 or earlier, you're fine. And really, a lot of deals bought in 2020 are going to be fine, just due to the tremendous velocity of rent growth and NOI growth that occurred. Real bottom line growth that will really push some of these early 2020 deals forward. And so really the majority of the stress are deals that were bought 2021 and the first half of 2022 at really the highest elevated prices. And, we're looking at several deals that have existing debt. Loans are coming due. The majority of the bridge money that was placed in the market had a 3-year initial term with 2 1-year extension options. And so if you bought a deal in 2021 with that term structure, the initial loan would be coming due this year in 2024. But there are 2 1-year options typically behind most of those debt vehicles. And so there's a lot of owners that are currently working to identify what is the right strategy to manage the pending maturity. If you value an asset today at a market cap rate today, you mark that deal to market. Obviously, there's impairment to the capital stack. The majority of the deals that I'm looking at in the market, the real risk is if you mark that deal to market and sold it today is held by the common equity. The majority of the loans that I'm seeing on buildings bought in 2021 to early 2022, there's still some equity behind the last dollar of the debt, or maybe the debt's near where the values are at today. Certainly, we've seen a handful of deals that have experienced some softness on the top line and some expense growth, coupled with high leverage bridge debt, and we are seeing some of those deals where the last dollar of the loan has real principal risk. Most of these bridge loans were sold, securitized through floating rate pools, and the majority of the originators, not all of them, but the majority of them were retaining some of the risk, oftentimes retaining the controlling interest in the stack behind the scenes, retaining the B piece in the securitization pools that were ultimately sold and securitized and utilized to finance these buildings. And most of these guys that are holding the B pieces, they're well aware of where the market is, and what's different today is there is liquidity in the marketplace. And so when you bought your first deal in Phoenix in 2008, you had to pay all cash to buy it. Today you can get an agency loan, you can get a bridge loan, you can get a CMBS loan. So there is liquidity in the marketplace. Rates are elevated, and so the math, just doesn't typically support taking out these loans that are maturing. But most of these lenders recognize that this is a self-imposed market correction. The GFC was market forced. There really wasn't any stopping it, and so it's the interest rate run up that's really causing the adjustment to the market.
We've seen also, cap rates, right? Expansion from, call it 3.5 to 5.5, maybe in a Phoenix market, right? Or 4 to 6, which obviously has a huge effect on valuations. I mean, I'm kind of surprised that you're saying that really the common equity stack is affected and not imposing into the loan stack, because we're seeing valuations on some of the 21, 22 stuff down 30%. I don't know if you're seeing that, at least 20 to 30% arguably in markets like a Phoenix or a Vegas, right? And so if those were financed with 85% bridge debt, that loan has to be impacted, doesn't it, at this point?
Yeah, I would agree. We're seeing 30 to 40% adjustments if you mark values to market today. But there has been rent growth that's occurred in a lot of these deals post-acquisition. And again, the majority of the deals that I'm seeing, the bulk of the risk is in the common equity. And we certainly are seeing deals where values are underneath the last dollar of the existing loan. That's not uncommon. I just think it's more common where those loans are close to where market values are at today. And most of the deals that we saw placed in the market were 75% loan to cost, and then call it Q2 2022, they were getting pared back more to like 70% loan to cost as lenders started to identify the run up in rates was going to adjust the market. But nobody predicted the significance of the run up because they were still transacting, still doing deals. And so there's most of these deals that were done, they're underperforming. They're not meeting projected NOIs. They're not hitting debt service coverage ratio tests, debt yield tests, or LTV tests that are tied to access the extension options that were originally contemplated in the original deal structure. But a lot of the lenders, they are retaining, the original originators are retaining that first loss piece. And they generally are the decision makers and are advising the trustees in these securitized vehicles on what's in the best interest of the balance of the shareholders in those trusts. And generally what we're seeing is that if you have an operator that is a good actor that's taking care of the real estate, is executing on their business plan, and the impairment is really market driven, the majority of these deals we're seeing the existing lenders accommodate requests to extend, modify the existing loans. Those requests typically come with some modest principal curtailment. There's extension fees involved with negotiating those extensions. And the biggest challenge for most of these owners is the rate caps that are having to be purchased.
Yep, I was going to ask you about that.
And,
yes.
When these deals were originally booked 2 years ago, again, as I mentioned, SOFR was around 8%. A lot of these debt funds were requiring that interest rate caps were purchased with a 3.5% strike rate. And every deal was a little bit different, but 350 is a good benchmark to use on the strike rate. And SOFR right now is 540. And so a lot of these owners have interest rate caps on these deals that are in the money and are paying out and helping to keep these loans current. But most of those loans had a rate cap with a term that matched the original duration of the loan. So if you did a 3-year deal back in 2021, you had a 3-year cap. And if you're going to extend and modify this loan, you need to go buy a new cap. And what I have not seen is lenders accepting the purchase of a rate cap with a higher strike. And so one of the bigger financial obligations to access a loan extension and modification is the purchase of a rate cap that's effectively in the money. So we're seeing several rate caps being acquired to facilitate these loan extension modifications, and they're buying the rate cap in the money. So the rate cap's paying out, as soon as the first day of the additional term starts. And so we're seeing several.
So Luke, can you explain to our listeners for a minute, the term in the money and sort of how that works? So basically what we're saying is, on these 3-year bridge loans, the lender at the time of origination made the sponsor, the borrower, buy a rate cap, right? That it could not exceed a certain rate for that same term, the 3-year term. But now that those 3 years are ending, which most of them are ending in 2024, as you alluded to earlier, that rate cap that they bought in 2021 might have cost $30,000, and now it's going to cost $1 million, right? I'm hearing crazy numbers to keep those rate levels, to your point, and the strike price is the price they were at upon origination. Is that what the lenders are seeking?
Yeah, generally. And so when the deal was originally consummated, the lenders wanted to put in essentially an interest rate ceiling that tied out to the original pro forma and cash flow projections, so that the loans would be able to stay current in the event interest rates increased. And so here we are today, rates increased higher than most people projected. And again, I'm using 350 as a benchmark on the strike rate. And so if you did a deal at 300 over SOFR and you had a rate cap at a 350 strike, your interest rate ceiling is effectively 6.5%. Now, if you didn't have that interest rate protection, that interest rate cap, you'd be paying 8.5% today. And so when I say these rate caps are in the money, they're paying the difference to the lenders from that 6.5% note rate to what the real cost of the debt is, which is, let's call it 8.5% today in our example. And so at the end of the day, the loans do need to be paid current to facilitate these extensions. And most of the deals would be below break-even coverage. Not most of the deals, several deals that we've looked at would be below break-even coverage if they extended the loans without an interest rate cap that was in the money. I mean, you could purchase a new rate cap that's in the money, or you could post a debt service reserve. Effectively gets you to the same place. Most lenders are preferring that the protection be provided through the interest rate cap. And we're seeing several owners have to acquire 7-figure interest rate caps to facilitate these loan extensions. But if we go back to why would a lender extend these loans? They don't currently have great pressure. The bondholders within these tranches aren't wanting to monetize a loss. And from the lender's perspective, if you can get a borrower to give you some modest principal curtailment, is it a 2% pay down on the loan? Is it a 5% pay down? We certainly have seen borrowers step up and make even larger pay downs and transition to agency capital. But if you're the existing lender and you can get the borrower to reduce the risk on your last dollar by modifying the loan, and you're extending this debt vehicle that's now paying you 8.5% to 9% money, I mean, that's really a pretty savvy business decision in my mind. They're getting a great coupon, and they are reducing risk with a principal curtailment. And most lenders, as do most investors, they believe that there is, a better environment that's in front of us in 24 months. And so, if you think we're at or near the trough of the cycle, forcing action today, would in theory, maximize potential loss, those shareholders in those different tranches. And so it seems like a prudent strategy for a lot of these lenders that don't have pressures that require them to move the loans to accept a modest principal pay down and, rebook this deal for 24 months and enjoy the benefits of a loan that's effectively paying you 8.5-9% interest.
Yeah, I guess the rub here is, a lot of sponsors that had, bridge debt, high levered during that time period were sort of thinly capitalized to begin with. Mm-hmm. And so now if you're the common equity and you're going back to your investors or business partners trying to raise $1.5 million to extend your rate cap, and they're looking at the project saying it's worth the loan amount or less, or most of our equity's wiped out, right? Isn't that kind of the challenge then of these sponsors' ability to actually raise new capital to work the modification for the lender?
Yeah, it's certainly a challenge. And I've been surprised by the number of investors that are able to actually meet some form of a capital call. And there's a variety of different ways that investors are successfully, raising this money. To bring new third-party sub-debt or pref equity into a capital stack, that money's not wanting to take risk with their last dollar at today's current market values. And so that's difficult if the existing loan's at market value. Most new capital that wants to come in wants their last dollar of exposure to be somewhere between 80 to 90% of today's market value. So a lot of groups are having to raise that money from the existing common equity. And we're typically finding investors layering in an additional class of investor interest that sits between the senior debt and the common equity. And I've been surprised that a lot of these groups are able to successfully source this small layer of additional capital to, effectively kick the can, as you said. It's not they're not having to raise the entire amount of common equity that originally came into the deal. They're probably bringing in another 5 to 10% to affect a structure that will be amenable to the existing lender, that improves their position and gets them this additional term.
We've heard, some of these existing, lenders that were very aggressive, like the Arbors of the world back in the day, they're structuring modifications. They're kind of bifurcating the loan, and you can explain this better in what you're saying. They're bifurcating that first loan into, a couple of different tranches, but also maybe putting some mechanisms in there where they're essentially financing the rate caps, I think, for the sponsors, or financing that extra tranche that you mentioned earlier. I mean, are you seeing some of that, right, to really also help them kick that can down the road?
There's a lot of different lenders that were active in the marketplace, in 2021 and 2022, and they're all impaired from the same market adjustment, which is really the run up in interest rates. But those lenders are they're not all capitalized the same. They don't all have the same perspective, from their chief investment officer in terms of what the right strategy is. Some lenders were more aggressive than others. Those that were more aggressive are going to be more willing to accommodate a B note request, which is what you were referencing, bifurcating the existing loan into two different tranches. So the deals that are severely distressed, you might find lenders more willing to break up that loan into an A note and a B piece, or maybe even contemplate a discounted payoff. But I think that's the minority of lenders and not the majority. I think most lenders are not going to be amenable to an A-B structure where you keep the A piece current, and then there's a hope note, if you will, where the B note gets paid back when the investor exits, and hopefully there's some improvement in market fundamentals that allows values to grow to pay back that B note that's taken. So there's different strategies that's being applied. I think the general consensus is that exiting today would likely maximize losses, and again, we just haven't seen enough pressures on the existing lenders to aggressively manage deals to an exit today.
Mm-hmm. Which is kind of surprising in some ways, because I gotta believe, given mark to market, that if these banks are truly mark to marketing their securities and their assets, that there's more trouble than sort of appears on the surface. And so from a regulatory standpoint, I'm a little bit surprised that they're sort of letting them kick the can down. And in my mind, it's an election year, right? There's a lot of things happening. I think the keeping the status quo during an election year always seems to sort of be the mantra. And I wonder if you think that might be playing into some of it as well.
Well, there's a lot of factors that are playing into it. I think where we'll start seeing lenders force action is when they run to the end of the term that was originally contemplated in the deal structure. And so initially we thought we'd start seeing distress at the end of the initial loan terms when these loans were maturing. And we are seeing, again, as I mentioned, lenders generally allowing extensions, modifications to borrowers that are cooperative and provide some improvement to the lender's position. But if you originally did a 3-year deal with 2 1-year options, you're looking at a 60-month window. And so if that deal is funded in 2021, 5 years down the road, we're looking at 2026. So I think where the action more likely gets forced is when you run to the end of the duration of the original loan terms that were contemplated, inclusive of the extension options. And so I think we'll still see some more aggressive action from lenders. I just think it's going to be further down the line than the market was originally expecting. So I think we might see some more forced action once these extensions start to mature on these loans.
Yeah, interesting, right? Because originally we were hearing like, well, you're going to start seeing distress in 2023, then for sure 2024. Now you're saying with the workouts that have been happening, really the maturity true end with the extensions is 2026, which is far enough away where who the heck knows, right?
Yeah, we may
be the economy is going to be, where rates are going to be.
Different environment.
Exactly, for better or for worse, right?
Yeah, hopefully for better.
Let me touch on. Let me talk about one other thing that you mentioned earlier that we didn't see during the GFC period, or at least on the stuff we were buying, we never saw, was really the mass introduction, if you will, of preferred equity into the capital stack in a lot of deals, right? When we were buying stuff, during the GFC, we really encountered very little, if any, pref equity involved in deals. I think the instrument's been around a long time, especially on larger, ground up development deals. But during the run up, a lot of preferred equity also got involved in these capital structures, along with these bridge lenders. And so, are you seeing that tranche of equity, the pref guys, being involved in these workouts, right? Because obviously they have a vested interest. They are in control to a certain extent of the common equity. And I'm wondering how pref is playing into this current environment and helping to extend, because a lot of times the pref equity would be a stronger, capital source sponsor than the true equity sponsor. So I wonder if how you're seeing that play out with the pref piece in some of these deals.
Yeah, I think it really varies from deal and pref provider. And I think pref is more commonplace today than maybe it was in 2021. But it's going to depend on the deal and what's the viewpoint of that pref provider. Expectation is that those investors will look to protect their positions, and they're going to make investment decisions that's going to be in the best interest to allow them to get a return of that capital and get a return on it. And when you layer in pref equity into a capital stack, what you're really doing is you're just increasing the intensity of the capital stack because the pref has a current pay. I mean, it's essentially sub debt. And so I look at it as debt, even though it isn't within the equity tranche. And so it puts more pressure on those general partners, and it really is going to make it more challenging for those general partners to monetize any promote or return of their capital on some of these deals that are aggressively levered going into the cycle. But yeah, if you're a large pref investor, you have influence on decisions, and they're definitely involved and they're at the table. But those decisions that they're making are ones that will allow them to best posture their position within that transaction.
Mm-hmm. Let's shift gears here for a minute and talk a little bit about the yield curve. The yield curve has been inverted. I was looking at it today since July of 22, which is amazing because I think it's now the longest inverted yield curve in history. And, almost every recession has been preceded by an inverted yield curve, right? And so if you want to kind of explain the Treasury yield curve and how it normally operates, and now that we've been in this inverted curve, what that means to investors and to borrowers. And I guess my second question along those lines is, if the Fed drops rates, federal funds rate, right? They're Fed funds rates. They're not interest rates per se. Do you think does the yield curve need to uninvert, if that makes sense? Does it need to uninvert and normalize, do you think, first, as if and when Powell drops rates? How do you think that plays into it?
Well, you're 100% correct. I mean, an inverted yield curve has historically been a very good predictor of a recession. But it's really, I think, correlation, not necessarily causation. And when we first started talking, you utilized the term, it's interesting. And, I talked to a lot of people on different sides of the business, and I continue to hear the term interesting when I'm talking to capital, I'm talking to investors, and I just think interesting is another way of communicating uncertainty. And so, yeah, we are in an inverted yield curve. It's been a very extended period of time that we've been in this inverted yield curve, and it'll be interesting to see what occurs, coming out of the cycle. The yield curve has flattened since the GFC, which certainly makes inversion a bit of an easier feat to occur. But typically, 10-year bonds trade at a much higher interest rate than shorter term bonds, and that's just because it's much more difficult to predict where the economy is going to be in 10 years. There's more uncertainty about where that market's going to be in 10 years, where the economy is going to be in 10 years, I should say. And so there's usually a term premium that is associated with buying longer term treasuries versus shorter term treasuries, right? Because it's easier to identify where that economy is going to be in the next 18 months or 24 months. And so, currently we're seeing 2-year treasuries greater than 10-year treasuries. And so the way I look at it simplistically is there's just more uncertainty today on what's going on in the near term than maybe the long term, which, we're in a very interesting time, to go back to your original term.
Oh, do you mean uncertain, Luke?
I mean uncertain. Yeah, exactly. There's just so much going on, here in the country as well as globally that's impacting investment decision. But the inverted yield curve does indicate the Fed's likely to cut rates at some point. It is an indicator that a recession's on its way, and generally we see loosened monetary policy to accelerate the economy. And so I do expect that as the Fed starts to loosen policy, that we'll slowly see that yield curve moderate, and if the economy picks back up, we'll see it normalize back to a more naturalized upward trending curve.
Right. But with the inflation we've seen and inflationary pressure still there, right? If and when does that loose monetary policy happen, I guess? That's
Yeah,
that's the $1 million question.
it's $1 million question, and recent sentiment is we're likely to see perhaps a cut here in September. You've got a variety of different opinions in the marketplace, but it's very difficult to predict rates, and again, there's just so much uncertainty here in the U.S. economy as well as what's going on globally that it's just very difficult to predict when we're going to start seeing some loosening.
Yeah. Yeah. I've been in the higher for longer camp. I don't want to be in that camp, but that's just what I believe. And so far it's been correct because I think the economy is weaker. I think employment is weaker. I think things are worse than is being reported. So I don't know. We'll see, right? Because you look at the BLS labor statistics and it's like, oh, it's such a strong job market. But then every month it gets revised down. And when you're not paying attention, you look, you're like, God, they revised those numbers down. Oh, and by the way, 2/3 of it is government jobs. So is it really strong? I don't know. Yeah. So again, very interesting times and statistics. Can we talk about the agencies for a minute?
Sure.
Since they're such a provider, the major provider to multifamily financing and a great stability to what we do, right? I mean, the agencies in multifamily financing, I always tell people, like, I love owning this asset class because having Fannie and Freddie really give it long-term stability, and they're always in the market. They may be less in the market, they may be more in the market, but they're always a source of debt and liquidity where, if you're an office building, maybe that's a bad example, especially today, or retail or industrial or whoever, you don't really have that governmental backstop. So what are you seeing on the agencies right now? Obviously, their volumes are down tremendously because I think overall volumes are down 70%-ish, right, in terms of transactions, something like that. Where are you seeing them on debt service coverage ratios affecting loan-to-value ratios? And maybe explain that for our listeners, kind of what a debt service is and how it affects how much loan proceeds. Because as you know, Luke, every time we look at a deal, right, it's like, well, here's the LTV you can get to. They'll go to 75 or whatever. But you're always constrained on proceeds because of debt coverage ratios. So can you kind of explain that and tell me what you're seeing from the agencies on that?
Yeah, I mean, there's a lot that you covered there. I couldn't agree with you more. The multifamily market definitely benefits from having Freddie Mac and Fannie Mae. I wouldn't call them a backstop to the marketplace, but in a lot of ways they are. They were created to provide liquidity, stability, and affordability to the mortgage market. And they're doing that to the multifamily market as well as the single family market, just by providing, offering available liquidity, access to capital to the many banks, mortgage companies, and other financial institutions that are active in the market. And so that's certainly a feather in our cap as a multifamily market participant to have Freddie Mac and Fannie Mae in our market and providing liquidity to ownership and supporting affordable rental housing. And transaction volume is down this year, and it doesn't matter whether you're selling buildings or financing them. Your numbers are going to be impacted. Transactions are just not happening unless they need to happen, and so we'll continue to expect to see Freddie and Fannie play a very active, formative role in multifamily finance. They, by mission, they really want to support affordable housing. And so I continue to expect Freddie and Fannie to be most aggressive in financing buildings that have affordability, whether there's regulatory agreements on those buildings or if they're just properties that have low rents relative to AMI. And so they'll continually aggressively support workforce housing across the country and continue to provide liquidity to ownership that supports affordable housing. So it's definitely a feather in our cap to have them in the market as an additional source of capital. We love working with both Freddie Mac and Fannie Mae. They're consistent, they're reliable, and they're a great source of financing for our clients and the market in aggregate. One of my favorite things from my seat is, Freddie and Fannie are consistent. They're consistent in underwriting methodology. They're consistent in approach. There's no situation or transaction that they haven't seen before. And so they have a very reliable, definable approach to underwriting cash flows and properties. And that approach hasn't changed in any meaningful way with the adjustment in the market. And so their methodology is really well structured to allow them to continue to provide this liquidity through the highs and lows of the cycle without overexposing themselves to risk that other lenders can find themselves taking on. We just spent a tremendous amount of time talking about bridge lenders in the market aggressively underwriting rent growth assumptions that stopped happening. And so Freddie and Fannie both will underwrite to a debt service coverage ratio, and they have defined approaches to calculating cash flows that back into those ratios. And generally speaking, a 1.25 times minimum debt service coverage ratio, or DSCR test, is the most aggressive DSCR for market rate rental housing. And we can certainly, the agencies will get more aggressive on truly affordable transactions. But generally speaking, market rate deals were sized into a 1.25 coverage ratio.
Right, which basically means, for listeners that don't know, you would need a net operating income, right? Your income minus your expenses of, just for simplistic terms, $125,000 to get a loan that would cost $100,000 a month.
Yeah,
right. That's the 25%
right.
differential.
That's right.
Yeah.
And so with the run up in interest rates, the debt service side of that equation has increased. And so borrowers in the market today, they're paying more money to access fewer loan proceeds effectively. And so, if you were borrowing at a 3% note rate and today you're at 5.5%, there's a pretty big difference in the debt service that you're paying per dollar borrowed. And so the ratio hasn't changed. What's changed is the interest rates that's used in the calculation. How you derive an underwritten NOI for Freddie Mac or Fannie Mae hasn't changed. So they've got a consistent approach, which allows us to navigate the market and efficiently get deals up and down with confidence and reliability. But that cash flow test is the dominant constraint on a loan sizing today. And that's going to continue to generally, drive loan sizings moving forward.
I mean, the one thing that does change, though, are their spreads, right? And so, basically agency loans are priced using a 10-year treasury plus some spread over that. And so that spread sort of ebbs and flows depending on the risk tolerance, the volumes.
Yeah, it depends on volumes, depends on where the market is. At the end of the day, these are securitized debt vehicles, Freddie pools loans, Fannie deals are single asset securitizations. So there is a back end market that these deals flow through. And so there is math that has to follow. So there is a market movement that can impact pricing on these loans. And, Freddie Mac and Fannie Mae, they are in a competitive interest rate, competitive environment. There are other lender sources, and they'll have deals that are more mission centric, that are a better target for them, i.e. workforce housing versus brand new Class A high end rental housing. And so, you will see a more aggressive spread on deals that have embedded affordability in them with a rent roll that has low rents relative to AMI versus a brand new high-end Class A property that is serving a segment of the renter pool that does not identify as closely with the mission for Freddie Mac and Fannie Mae, which is providing affordable housing. And so spreads will vary based on the deal. It'll based on what's going on in the competitive marketplace, and then it'll also vary heavily on leverage. And so if you're a more conservative borrower and you can accept more moderate leverage, you will benefit from a lower interest rate. And so if you move from a 1.25 DSCR to a 1.35 or a 1.55, you will see a more efficiently priced debt solution if you're able to execute a business plan with less leverage.
Yep. The more equity, the less risk for them, and the better deal you will get, right? Essentially.
Exactly. Yep.
Hey, Luke, I think we're kind of bumping up on time here, but before we wrap, I just kind of wanted to get your take on what you think the market has in store for the next 12, 18 months. I mean, we're in an election year. How much do you think a Trump victory or a Biden victory impacts the capital markets and what we're seeing, and kind of what's your prognosis for the next couple of years?
Well, it's very difficult to predict forward, and it seems as though the investor market, the ownership market, has a general consensus that we're moving into a interest rate declining environment. Over the last 24 months, we've been in a interest rate increasing environment, and it's interesting to watch borrower investment decisions react to these movements in the marketplace. And so, if you bought a deal 3 years ago, you're really wishing you would have put a fixed rate loan on that deal rather than a floating rate loan that adjusted upwards. Yep. And so it'll be interesting to see if we really truly find ourselves into a declining interest rate environment. My general expectation is we'll see a modest pullback on the policy from the Fed. I don't expect to see any aggressive action. 3% borrowing rates, I don't see those coming back. We have seen a recent drop in bond yields. Just over this past week, the 10-year Treasury is around 4.16, the 5 years at 4.07. The curve itself is flattening. But we've got some very unprecedented events that are occurring nationally, globally, that have potential to impact financial markets. The election, I'm afraid it's likely to be contested regardless of who wins, which is a very interesting adjustment to our country here. Deglobalization is a major theme that's occurring here in the U.S. The government is spending a tremendous amount of money to facilitate that deglobalization. And hand in hand with that is burgeoning debt loads that the U.S. Is holding. And then you can couple all of that with this tremendous geopolitical risk that's occurring globally. And so, here we are back to this term interesting, which is just all of this tremendous uncertainty, which sets you up for potential volatility. And so it's, again, I think the investor market has this consensus that you're going to see this meaningful movement into a better borrowing interest rate environment. And while I'm hopeful that happens, because that will improve values, it will spark transactions, it'll move the market forward, I think this is a great time just going back to basics as an investor, really focusing on those operations and trying to mitigate capital risk rather than perfect market timing on interest rates. It's just difficult to perfectly predict rate movements. And in my mind, it really adds risk to a business plan. And so I think a traditional strategy of affecting and executing fixed rate debt strategies on loans that have some amortization in the loan terms on a portfolio with staggered maturities is really a safe approach to the market today. And so we have several investors that are waiting, hoping for a drop in rates, and they've got some deals that you can lock in and will pencil very nicely. If you're locking in a mid 5% interest rate today on a deal that's generating great cash flow, I think that can be a great decision to lock that in, focus on your business plan, and manage the asset and take capital market risk off of the table. And so we'll see what comes out of the election and interest rates, but I think a conservative approach is probably the best strategy today.
Yeah, and I think that's right. And that's kind of what we've done at CalCap, as you know. I mean, our portfolio is basically 10-year fixed rate debt, mostly through Fannie and Freddie. So I feel pretty good about those decisions. We do have the one loan you're refinancing. We only have one loan that was a bridge loan that you're refinancing. That's at about a 20 loan to value. So not too worried about that one either.
We'll take care of that one regardless. But yeah, yes, you guys have a great approach, and I agree with it. And pleasure to be here chatting with you today.
Yeah, no, I appreciate it, Luke. I think you've given a very good synopsis to our listeners as to kind of where we were in the market, how we got to where we are today, and sort of a little glimpse on hopefully things getting slightly brighter or really brighter in the future. We shall see. But I guess to cap the theme, I'll quote the ancient Chinese proverb, "May you live in interesting times." And we certainly are living in very interesting historical times. There's no question. So thank you, Luke. Once again, I appreciate your time today, and have a great day.
Thanks, Ed. Great to be here.
I hope today's show inspired you just a little bit, and I would like to thank my guests once again. I'm excited to bring you more episodes with interesting and informative experts to help you navigate your way to wealth and health.
Thanks for listening to the Real Estate Wealth Podcast. The Real Estate Wealth Podcast is produced by Truthwork Media. Our producer is Seth Creekmore, with support from McKenna Smith. For show notes and more information about this podcast, visit edaloe.com. For more information about CalCap Advisors, visit us at calcap.com or follow us on Twitter at CalCap Advisors.
I'm your host, Ed Aloe, and thank you for listening.